Hello, everybody. Ed Yardeni here. Thank you for joining me today. Well, it's another hot day here in Long Island, but compared to some other parts of the country and the world, it's pretty cool here. We got temperatures in the 90 with a lot of humidity, a lot of thunderstorms. We had a great spring, plenty of sunshine, and very nice weather all in all. But this summer we've had a lot of rain and a lot of thunderstorms, especially on the weekend. So it's been a bit of a drag so far this summer. But again, we count ourselves lucky. We know how it is for some of you folks down in the South, Southwest Texas, Phoenix, and places like that. I heard that Death Valley is expecting a record heat reading, something like 130 degrees, and that there's actually some tourists who want to go out there and say that they were there when the temperature was that high in Death Valley. Doesn't do it for me. Kind of wondering whether the rubber on the tires is going to melt and leave you stranded in that part of the world. Anyways, I did a little round trip today to New York City, went to the NASDAQ, did an interview with the morning show at 8 o'clock with the CNBC folks, and had a little chat about things, the economy, inflation, round up the usual issues, and we certainly discussed them, and it was worthwhile. Still a little concerned of whether I'd make it back in time for the call here, but had plenty of time to spare. So here I am, and here you are, and again, there's plenty to talk about. Let's start by talking about China. Let me go to and share this screen with you. And you should all be getting not only the morning briefing, the weekly briefing, and tuning into our webcast, but you should all be getting the quick takes, which is a product we've had out now for about a year, and it's been quite popular. So we're glad to get some good feedback on that one. But let's look at this one that we did on July 13th. Today's July 17th, so it's only a few days back before the news that came out this morning on China. The news this morning said that China's economic growth rate is slowing down appreciably. It restated what we know, that the property market is in trouble. They've got too much supply, not enough demand, and the builders are having some issues with getting credit and making their payments. So it's an issue. I'm going to make this a little bigger. So back on July 13th, and this is not the first time we've indicated that there's trouble in China. We noted that China's, this is seasonally adjusted data, by the way. Our data vendor, Haver Analytics, takes the not seasonally adjusted data and does adjust them for seasonality. So they do a nice job there. And you can see that imports have been absolutely flat since the second half of 2021. Why is that important? Well, I think it's an indication of domestic demand. If they're not importing, then domestic demand isn't that great. Also, the demand for their exports may not be all that great because they import a lot of raw materials and intermediate products that they put into finished goods. So it's all related, and we can see that there has been some weakness over the past couple of months in Chinese merchandise exports. So that was one tip off that there's something wrong with China's economy. Another one is, you go around the world and everybody seems to have an inflation problem, except China. China's PPI in June was actually down 5.4%. Their CPI is absolutely flat at zero on a year-over-year basis. So I think between the property calamity crisis that they have and the demographic calamity, I should use the word for calamity for the demographic crisis that they have because of the one-child policy, they've got a rapidly aging population. I've often of late referred to China as the world's largest nursing home. And I think its demographic profile is increasingly and more rapidly turning more geriatric. And as a result of that, I think they're not getting the consumer spending, the domestic spending that they were hoping would stimulate their economy. Why is this all important? Well, China obviously is a indicator of the global economy. So it's indicating that the global economy is slow. And of course, China is very important to the global economy as a source of demand and supply. So some of the weakness in the global economy clearly has to do with China's economy. And to the extent that they've got deflation in the PPI and disinflation, actually no inflation in the CPI, that can certainly have an impact on the rest of the world. And I've been arguing of late that a lot of the inflation problem we've had over the past 2 years has been transitory, and that we don't really need a recession to bring inflation down. But another reason we don't need a recession to bring inflation down is because of China's deflation. If the economy is slowing and their PPI prices are going down, that has an impact on the US. Take a look at this chart, which shows the US PPI. This is PPIs, both of them. So this is China PPI, total industrial products, and this is the US PPI for finished goods. And you can see that the correlation is pretty good, and it kind of makes sense, obviously, since we are important trading partners with one another. And of course, on the good side, China's had an outsized influence on the impact of goods prices in the United States. And sure enough, as you can see, the China's PPI inflation rate has come down into deflation, and ours is doing the same with just a little bit of a lag. This is the US PPI for goods and services. So even on the services side, we're seeing disinflation. We aren't seeing outright deflation yet, because obviously services aren't impacted by what's going on in China as much as our goods. Let's go back to the chart package for today's morning briefing. And you can always find these things somewhere on the website. In this case, we've got it under morning briefings. I like to go to this area, bullet points and charts. That just kind of gives you the executive summary with the charts. So I can just pick off the charts right there. And so here we go. Again, most of the morning briefing was devoted to the subject of disinflation. Immaculate disinflation is what I call it. I think that term's been used elsewhere, so I'm not going to claim that I came up with it. But the idea is that can we have disinflation without a recession? Can we have so-called immaculate disinflation? And our position is that's what we're seeing, and that's what we'll likely to continue to see. That a good part of the inflation problem we've had has actually turned out to be transitory after all. Remember back in 2021, we all remember that the Fed sort of took a leading position on inflation and said it was transitory, and everybody else sort of agreed. I agreed, everybody agreed. But by early 2022, and especially once the inflationary pressures emerged from the war, Russia's invasion of Ukraine, suddenly everybody was saying, well, maybe it's not so transitory after all, and it's more persistent. This was in 2022. And the Fed started to get really anxious about that. Fed officials started to fear that inflation wasn't transitory after all, and that they were responding to it too little, too late, and that they had to move much more aggressively in raising interest rates. And that's exactly what they did. And because of their mistake in viewing inflation as transitory, they didn't move to start raising interest rates until March. And then they realized that they had a problem, and they started to go wild, going from basically zero Fed funds rate to 5% Fed funds rate in basically a year. And now we're seeing some moderation in inflation, and people are saying that obviously the Fed's tightening has contributed to that. But again, I think that a good part of the inflation has in fact been transitory, particularly in the area of goods inflation. And I think even in the services inflation, a lot of that problem was in rent, and rent inflation was boosted again by transitory factors. I'm arguing that the pandemic was a big deal. It was a major economic event that created lots of shock waves and aftershocks that were visible in all sorts of ways. And one of them was impact on inflation. And clearly fiscal and monetary policy contributed to the inflation, because in response to the pandemic, we had excessively stimulative fiscal and monetary policy. And as a result of that excessive stimulus, consumers came out of the lockdowns in a buying mood. They had cabin fever. They wanted to go shopping to make themselves feel better. They couldn't buy services because there were still a lot of social distancing restrictions on services, airlines, hotels, and people were just not ready to get together in large gatherings. But they had no problem putting on a mask and going to a store. So we had a buying binge for consumer goods. The price inflation went wild in the goods area. And that, of course, created the supply chain disruptions. But by 2022, the summer of 2022, a lot of those supply chain disruption issues were abating. Why? Because people went on a buying binge and bought what they wanted to buy. And then by 2022, they were pivoting away from goods to services. And meanwhile, the retailers had ordered too many goods to replenish their inventories, and suddenly they were stuck with merchandise they couldn't sell, so they had to discount it. And so that contributed to disinflation. So inflation is a complicated phenomenon. It's not just a monetary phenomenon. Even in the great inflation of the 1970s, it wasn't just a monetary phenomenon. We had two energy shocks, which were geopolitical in nature. We had a problem with the anchovy crop in the early 70s in Peru, and so that led to higher grain prices. But certainly policymakers also contributed to that, and the psychology of inflation fed on it. But I think we are seeing that the Fed's fast actions, or delayed fast actions in terms of dealing with inflation, at least probably had a beneficial impact on anchoring or keeping inflationary expectations down. Well, let's look at some of this. First of all, with regards to let me just make sure I'm on the right page here. Give me a minute. Yeah, no, we're fine. All right. So with regards to the idea that the economy needs to go to recession to bring inflation down, well, the economy hasn't gone down. It's been resilient. The recession story is still out there. There's still people who think that compared to the pandemic environment, we have depleted excess savings, but maybe there's $500 billion in excess savings left. Back here, if you estimated, various estimates have come up with $2 to $3 trillion of excess savings. And we've worked through that. And as you can see, the amount of personal savings at an annual rate has come down. It's below its trend. And so the thesis is that we're going to, within the next few months, run out of excess savings, and therefore we're going to fall into a recession. And again, I don't think we need a recession to bring inflation down, but the recession folks, the naysayers, are still pushing their scenario that inflation remains too high relative to the Fed's targets, and that willy-nilly we're going to get a recession at any rate. So now, if you look at another argument they've been making, the recession folks, is that M2 is falling. Demand deposits are kind of flattening out. Total deposits at the commercial banks, we have weekly data. We used to get the money supply data, M2, on a weekly basis. They discontinued that, and now we get the deposits data at the commercial banks. We can at least look at that as a kind of a weekly indicator of what's going on with the money supply. But this is a fairly popular notion among the naysayers about why the economy is in trouble. Now I look at the trend line of M2 and deposits relative to today, the trend line prior to the pandemic. And I'm still saying that M2 and deposits are something like $500 billion to $1 trillion above their pre-pandemic trend line. So a lot of this weakness just reflects a lot of that boom that we had in liquidity during the pandemic. Now, when you look at demand deposits, which are the most liquid component of M2, you can see that they're still extremely elevated. And I don't know how this is all ratio scale. So, if we draw the trend line here, we're still going to get $1 to $1.5 trillion of excess savings in demand deposits relative to the trend line. Look, again, the pandemic was a traumatic event. There may very well be a precautionary demand for liquidity. People may just say, no matter what the opportunities are in the stock or bond market, I want to have more in liquid assets than I've had in the past prior to the pandemic. Well, here's another take on this liquidity. You can see here the all commercial banks' total deposits on a weekly basis, combined with money market mutual funds held by institutions and individuals. And you can see that that's actually looks like it's edging back up to a record high. And again, it took a real jump here. And certainly doesn't look like we're kind of trending back to the uptrend before the pandemic. So again, I think there's a certain amount of liquidity preference. But the important thing about that is that once people feel more and more comfortable that things have normalized, that liquidity is still there, and it can certainly go into the bond market, into the stock market, into the economy. And maybe that's one of the reasons the economy has been so resilient is in the face of the Fed tightening, is as much as they've tightened, they are fighting the fact that they provided a tremendous amount of liquidity during the pandemic environment. And so, but it hasn't turned out to be inflation, has persistently inflationary, but instead is more transitory in nature because, again, the pandemic had transitory impacts on inflation, like the supply chain disruptions, like the impact on causing home prices to soar, which then caused rent inflation to soar. And now we know that rent inflation is moderating. We've also made this point that when you look at the liquidity by demographic cohorts, by the profile of the silent generation, baby boomers, Gen X, millennials, you see that the baby boomers are sitting on lots of liquidity. And so to the extent that this generation is in their late 60s, early 70s, starting to retire, maybe they're holding that on as precautionary balances, but the fact is they also have a lot of money to spend if they so decide. Meanwhile, the concern about inflation isn't just about prices, but also wages. And we are seeing that wage inflation is turning out to be somewhat more persistent than price inflation. But keep in mind that some of that may very well reflect that we're kind of normalizing here, and that we're starting to see that wages in real terms are back to increasing along this 1.2% trend line that they've been on since the mid-1990s. You can see that for a while here, for a couple of years, we stagnated in real incomes. So nominal wages went up, prices went up as much, and everything stagnated. Consumer confidence took a dive. Even though the labor market was really strong, people were kind of frustrated that they were getting wage increases, but those wage increases, purchasing power was getting eroded by high inflation. But now we're starting to see that real wages are starting to increase, and that can only be sustainable if productivity is making a comeback. Productivity was certainly upset by the turnover in the labor market, by the quits and the hirings, just a tremendous amount of turnover, lots of job openings. But I think all that is slowly but surely settling down, normalizing. And if that's the case, that should reverse some of the factors that were weighing on productivity. And then, of course, there's the whole technology revolution, not just AI, but robotics, automation, onshoring, and so on. So the consumer, all in all, is in good shape. Real wages are going up in the past few months. I think it's about 5 months now that real wages are going up. When we look at total real disposable personal income, we can see that that's been on an upward trend as well. That's this one here. You can see this was all messed up by the checks that were sent that boosted disposable income. Then we had the excess savings, and wages were being eroded by prices. So disposable income actually eroded here, but now it's back on an upward trend, which obviously is one of the main factors driving real personal consumption. Another factor here is that personal income isn't made up just of wages and salaries. There's also unearned income, and you can see here dividend income, interest income, proprietor's income, rental income, Social Security, all at record highs in current dollars. If you look at the sum of all those unearned components of personal income, just to get an idea of how big they are currently equivalent to 65% of wages and salaries. So that's really pretty impressive and needs to be considered when we think about the consumer. So I think the consumer's optimism reflects the fact that they believe that inflation is moderating, the labor market remains strong, and their real wages are increasing. But meanwhile, it's the same old story with what they're doing with their incomes, their available purchasing power. They haven't been spending it on goods. Goods inflation has been goods spending in inflation-adjusted dollars has been absolutely flat, basically since, let's say, the second half of 2021. It had that big buying binge over here. Then as the service economy started being more accessible, you can see that the service spending started to increase. So they pivoted away from goods to services, and that's kept the economy going. It's possible here that if we just extrapolate the trend of real goods consumption, that at some point in the next year or two, we'll catch up with that trend, and then this will start rising again. I know everybody is looking for a big increase in retail sales. I think that number comes out on Wednesday for June, but I would just point out that retail sales is merchandise, it's not services. It does have food services in there, so we'll have to see what that does. And that sometimes is a good indicator of what services generally are doing, but we'll be looking at it for you. Other sources of cash out there. Again, I just want to point out there's a tremendous amount of liquidity in the system, notwithstanding the Fed's tightening of monetary policy. And yet we've seen that inflation seems to be much more transitory and less persistent than was feared over the past year, not that long ago, and even now by some people. So corporations are flush with cash. This is corporate cash flow, basically at a record high of $3 trillion. This is the Fed has in its flow of funds statistics measures on non-financial corporate liquid assets. They got total, which is kind of a funny number because it includes equities and mutual fund shares held by non-financial corporations. So if you don't want to look at it that way, you can still look at it without that. And that's also at a record high of $3.6 trillion. Federal government still pumping liquidity into the system, basically through these large deficits. The deficit's expanding again as outlays are expanding while receipts are coming down. Now, some of you may be looking at this receipts and say, this is not an indication of the recession. I think, again, everything has to be put in the light of the pandemic experience we've had. And some of the things that are going down because they went up a lot. And we had a lot of tax receipts when the government was handing out checks. It wasn't completely tax-free. You did have to include that in your tax returns. So some of the checks went back to the government as tax receipts. And now we're sort of seeing the flip side of that. So back to inflation. Here's consumer price inflation for goods. And that certainly looks like a round trip. Inflation does seem to have a symmetry to it. The faster it goes up, once it peaks, it seems to come down at about the same pace, at least just visually. And here we are with deflationary numbers, total minus 1.2, durables minus 0.8, and non-durables down 1.3. And again, a lot of that seemed to have been transitory, related to the supply chain disruptions, and those things are more than over, based on this Federal Reserve Bank of New York statistic on supply chain pressures. Rent inflation, we all know this chart. We know that Zillow and Apartment List reflect current leases that are being signed, and you can see that's come down quite dramatically. And it does suggest that we're starting to see a peak in rent inflation on a year-over-year basis. So this is the persistent component of inflation, but it's persistent mostly because of the way it's calculated. The actual experience is for much more disinflation in rent, and rent is a big part of the CPI. I think this is kind of interesting, don't you? CPI excluding shelter. So this is the headline: excluding shelter is only 1.7%, and the core excluding shelter is 2.7%. And again, a certain symmetry about it. So I think inflation is going to continue to come down. I think 3 to 4% is what we're looking at this year, and 2 to 3% I think is achievable next year. As I said, there is sort of a symmetry in inflation. You can look at the history of inflation, year-over-year percent change, and you don't get kind of a situation where it goes up and then it takes forever to go down. Now, this entire experience was demonstrated that inflation is not always and only a monetary phenomenon. There were some energy crises involved here, lots of other events that occurred that made things worse. And the same holds for this current situation. We had the pandemic, we had the supply chain disruptions, we had the elevated turnover in the labor market, and all that seems to be calming down now, and inflation is moderating to the extent that it's down to 3% on a year-over-year basis from something like 9%. So I think the data is pretty clearly in sync with the idea that that disinflation is the name of the game. Let's do some Q&A here. I spoke way too long here, but let's take a few. Okay, Kim. Hi, Dr. Yardeni. I wonder if you could take a few minutes to share thoughts on the situation in Japan. There have been a lot of inflows by U.S. investors lately. Are the lost decades really over? Is it time for Americans to invest in Japan again? Good question. We did do a piece on Japan a few days ago. We had a closer look at it. It looks as though part of the reason that the Japanese stock markets had a big rally was that at least until the past few days, the yen was very weak, and a weak yen benefits their exports, and a lot of their companies do exports, and that helped the stock market. But I think a lot of it had to do with valuation. The Japanese stock market has been extremely cheap on a valuation basis. I think it's been like 11, 12 kind of multiple, and now it's jumped up to about 14, 15 multiples. So I think there was some of that. Maybe there's some idea that inflation's making a comeback. It's no longer deflation, but I think it's premature to make that argument. I think deflation is still very much has a demographic component to it, and Japan's demography is inherently deflationary. So I don't really have a problem with investing in Japan. And by the way, I think some of that might have been AI hype, because to the extent that the AI concepts got overvalued here real quick in a matter of days and weeks, maybe investors started looking around the world saying, what other companies around the world might get involved in AI. So maybe some of the Japanese tech companies benefited from that. Ian, do you think the banks have long-term upside as yields on loans have been going up for the past 6 quarters? And once the Fed ends rate hiking, deposit beta will also normalize. Banks will find the sweet spot, possibly raising pricing. Yeah, we like financials. We like the banks. We have been arguing since the banking crisis that it's not going to be a meltdown situation. We're not going to be thinking about which banks don't we want to own, but increasingly we're going to be thinking about which small and regional banks do we want to own because of M&A activity as they consolidate. Obviously, their costs of doing business are going up with regulation, and there's going to have to be some consolidation to deal with that. And I think that'll be bullish for the sector rather than bearish. And the big banks clearly have gotten through this crisis in good shape and benefited in some ways from it. Some of them actually gained deposits. 10-year Treasury yields have dropped by about 25 basis points in the past week. This is from Robert. The past week to 3.85 today. Where do you see this rate going for the rest of this year? I'm in the 3.5% plus minus 50 basis points, if you'll allow me to that kind of range. Back in late October, October 24th, we said that we thought, actually a little later than that, we thought that, we said that the 10-year bond yield had peaked on October 24th at 4.25%. That seems to have worked out so far. We also, back in late October, called the October 12th bottom, and that's seemed to be working out well also. Okay, Ian. Other economists point to labor as the key to inflation and note declining productivity with rising compensation, which equals higher core inflation. Thoughts? Yeah, look, it's an issue that still needs to be addressed. I mean, just because we had, I think it was Fed Governor Waller last week said, hey, look, we had a string of 4 CPIs that were up 0.4% per month. And now all of a sudden we get a June number at 0.2. And, everybody got excited because on a year-over-year basis, it's up only 3%. And he basically said it's good, but, he wants to see more evidence that inflation really is coming down at the price level. He didn't talk much about wages, but you make a good point. That we're seeing disinflation in wages, but wage inflation still remains sort of 4 or 5% kind of number. But I'm in the camp that believes that productivity is making a comeback, will make a comeback. Again, the roaring 2020s concept, which seemed kind of delusional, even to me, that we were promoting. It was hard to talk about the roaring 2020s back in the depths of everybody's fears and misery in the first half of 2022. But we kind of regained our composure and optimism, and it's worked out pretty well. And so we're kind of back to discussing the idea that productivity will make a comeback. The technology solves problems, and the biggest problem we have right now, well, one of the biggest problems we have from an economic standpoint is a shortage of labor, and technology will solve that with productivity. I'll take one more here. What about the government debt? Is that ticking time bomb next to medium term? Look, I've said it a few times before. The government debt is a problem that I've seen in the 40 plus years that I've been in this business. It has yet to create the doom and gloom scenario that the doomsters have been talking about. I've kind of sort of come to the conclusion that all this government debt is basically the baby boomers taking advantage of their kids. They're leaving their kids a lot of government debt. But on the other hand, they're also going to be leaving a lot of net worth. As I've been pointing out of late, the baby boomers are sitting in a record $75 trillion of net worth. So, some of our kids are going to do all right to the extent that they get a legacy from their parents. But all the kids are going to inherit larger and larger government debt while we're running these huge deficits. And that's going to make it harder for them to run deficits, to make things easier for themselves, the way the baby boomers have made it easier for ourselves by constantly running deficits whenever we feel that there's that we need to avoid too much pain. Well, I hope you don't have any pain this week. I hope you have a good week. Should be an interesting one with the focus on the state of the economy with retail sales and industrial production and composite indicators. Thanks for joining, and we'll see you again next week.